Welcome to vTalkInsight, Market Drivers Daily for December 13th, 2025. AI, growth, and geopolitics are colliding in markets right now as investors reassess lofty expectations for artificial intelligence, lean into a surprisingly resilient macro backdrop, and navigate a more confrontational political landscape. Let's start with how the AI trade is evolving from a simple momentum story into a far more nuanced test of earnings, balance sheets, and policy risk. The AI theme remains the main macro swing factor, but the tone has shifted from pure euphoria to a demanding show-me phase. On the one hand, capital spending is enormous and still rising, with estimates of around $350 billion of AI-related investment this year alone and multi-year backlogs for data center and industrial projects. Supply, not demand, is the constraint in much of the stack, from NVIDIA's H200 chips to optical components, which is why equipment providers speak in terms of multiple investment cycles stretching over a decade rather than a one-off boom. Yet recent price action shows how unforgiving the market has become when expectations slip, even against that strong demand backdrop. Broadcom is a clear example. The company delivered strong AI revenue growth and flagged a $73 billion backlog to be shipped over roughly 6 quarters, with AI sales expected to double year-on-year and accelerate again by 2026. Despite that, the shares fell sharply, at one point more than 11%, as investors focused on narrower margins, a lack of clear 2026 guidance, and the rich starting valuation near 40 times forward earnings. That follows weeks of scrutiny on Oracle, where aggressive, debt-financed AI infrastructure plans and dependence on OpenAI have turned its balance sheet and credit spreads into a key gauge of AI-related risk. As a result, the market narrative is tilting away from pure infrastructure build-out and toward evidence of real adoption and profitability. Major banks see 10 to 12% annual earnings growth for equities over the next 2 years, and forecast for the S&P 500 point to around 12% earnings growth next year, with AI-driven productivity at large caps doing much of the work. But investors are increasingly demanding proof that AI is delivering returns beyond the hyperscalers, watching closely for enterprise use cases in areas like financials, healthcare, and retail, where productivity gains could support margin expansion and eventually higher valuation multiples. Deals such as Disney's billion-dollar investment and content partnership with OpenAI highlight new monetization routes for intellectual property, even as questions linger over the size of the bet and how revenues will actually be shared. At the same time, the risks around AI are broadening from pure valuation to security, energy, and regulation. Inside many enterprises, a significant share of AI usage is unsanctioned, the so-called shadow AI, which is driving demand for integrated security and networking platforms that can detect and control interactions across cloud environments. On the physical side, data center demand is straining grids, with Europe in particular facing permitting delays and electricity access constraints even as North America leads current deployments. This is feeding expectations for heavy investment in power infrastructure and grid modernization, and even turning electricity supply into an election issue in some jurisdictions. Policy uncertainty adds another layer, from fragmented state-level AI rules in the U.S. to executive actions that may be challenged in court, while legal battles over intellectual property and actor likeness in media could reshape how value is shared between content owners and model providers. All of this explains why the bubble debate around AI is intensifying even though consensus does not yet see a full-blown mania. Risk assets, more broadly, are effectively priced for perfection, assuming strong AI-led productivity by 2026, while some investors worry about circular investments, rising leverage, and tech firms shifting from asset-light to asset-heavy models. Credit markets remain supportive, but spreads on names like Oracle have widened, underscoring how quickly sentiment can flip when CapEx plans start to look misaligned with realistic cash generation. Looking ahead, the coming year is shaping up as a pivotal show-me period in which guidance on AI monetization Energy constraints and regulatory clarity could drive large dispersion between infrastructure providers, adopters, and more speculative platforms. The broader growth picture is increasingly tied to whether this AI investment actually translates into the earnings and productivity gains now embedded in forecasts, which brings us to the global growth narrative. The macro backdrop still looks late cycle, but more growth-friendly than many expected a few months ago. The Federal Reserve's latest projections point to stronger gross domestic product through 2027, with higher growth, stable unemployment, and lower inflation, and that has reinforced a constructive soft landing narrative. Global forecasts are anchored around 2% growth for the U.S., 1 to 1.5% for the euro area, 4 to 5% for China, and just over 3% for emerging markets, excluding China, suggesting a broadly resilient world economy into 2026. Policy is central to that story, and markets are now juggling a complex mix of fiscal and monetary signals. On the one hand, robust U.S. fiscal stimulus, estimated at around $11 trillion annually, plus upcoming tax cuts and potential new expensing for capital investment, are expected to support activity well into 2026. There is also anticipation of additional fiscal support from China and targeted measures in Europe and Japan, feeding a 2026 Goldilocks narrative of moderate inflation, fiscal easing, and broader cyclical participation. On the other hand, the Fed's own projections of stronger growth and lower unemployment reduce the case for aggressive rate cuts, and there is a real possibility that if AI delivers a meaningful productivity shock, real interest rates could drift higher, challenging the popular lower for longer view. This growth rates tango, where stronger activity pushes yields up and higher yields then threaten valuations, is a key source of potential volatility. Corporate earnings expectations are aligned with that more optimistic macro profile. Consensus sees earnings growth of around 10% last year and roughly 14.5% this year, with major banks projecting 10 to 12% annual earnings per share increases for equities over the next 2 years. Deutsche Bank even sees the S&P 500 reaching 7,500 by the end of 2026, underpinned by continued U.S. outperformance and double-digit equity returns. Importantly, leadership is broadening. Earnings growth among mega-cap AI and tech leaders has slowed from above 50% to closer to 20%, while small caps, financials, industrials, materials, and energy are seeing accelerating trends. That shift is showing up in flows and in sector calls, with upgrades for industrials and materials and growing interest in beneficiaries of AI-driven capex, from data center-related industrials to housing and infrastructure names. Under the surface, the consumer and labor data add nuance to the growth narrative. Retail sales for November looked soft on the surface, with core sales flat month-on-month, but year-on-year gains were better than many holiday forecasts, and calendar quirks from a late Thanksgiving likely pushed some Cyber Monday spending into December. Survey data suggest a majority of Americans plan to increase spending into 2026, helped by higher prices but also by a structural preference for services such as dining out. Millennials in particular are driving restaurant demand, and digital engagement and social media presence are becoming critical for hospitality revenues. At the same time, productivity is improving even as unemployment edges up, pointing toward a kind of jobless growth where companies use AI and automation to maintain output with fewer hires. AI-related job mentions have risen from about 2% to 5% of postings in just 3 months, even as employers pull back on some higher-cost roles and increase openings for entry-level positions that do not require a college degree. Credit markets currently reinforce the positive growth story, but also highlight vulnerabilities. All-in yields remain attractive, and both investment-grade and high-yield are drawing interest, yet spreads are tight and positioning in U.S. credit is heavy, leaving limited room if defaults or downgrades pick up. Private markets are rebounding, with U.S. deal volumes expected to rise roughly 35% year-on-year, and European activity set to surpass 2021, and 2025 is on track to be the second strongest year for global merger and acquisition volume after 2021. AI-driven investment is a major driver of this, funneling capital into data centers, industrials, and real estate. Looking forward, upside risks to growth include sustained AI-led productivity and continued fiscal support, while downside risks center on a sharper deterioration in labor markets and a mature credit cycle. For multi-asset portfolios, the key watch points are whether earnings breadth continues to improve, how far the Fed actually follows through on rate cuts versus current market pricing, and whether higher long-term yields start to pressure valuations and activity. Those macro and credit dynamics will also shape how sensitive markets are to the next set of geopolitical shocks. Geopolitical risk remains elevated, but the channels are increasingly financial and energy-related rather than purely military. In Europe, debates over how to use frozen Russian assets to support Ukraine illustrate how policymakers are turning to the balance sheet as a tool of statecraft. In the Americas and the Middle East, sanctions on oil producers and more active maritime enforcement show a willingness to use energy flows as leverage, with knock-on effects for inflation and rate expectations. For markets, the key is that these risks are persistent and cumulative, even if they have not yet forced a wholesale repricing of global risk assets. The Russia-Ukraine conflict is now as much about financial pressure as it is about the front line. European leaders are moving toward changing asset freezing rules from unanimity to majority voting, allowing the EU to indefinitely freeze Russian reserves and potentially direct the proceeds toward Ukraine, even over objections from countries such as Hungary. Belgium, where a large share of those assets is held, is pressing for risk-sharing guarantees before agreeing to monetization, given concerns about legal or financial repercussions once the war ends. Analysts see the banking and fiscal risks from using those reserves as significant, but manageable if guarantees are collective. Yet a misstep could undermine confidence in European banks and test the assumption that seized assets are sacrosanct. Failure to reach a deal could weaken Ukraine's negotiating position and force concessions in any future peace talks, while ongoing EU discussions and NATO warnings about preparing for a larger conflict keep defense stocks supported. Across the Atlantic, the U.S. debate over security guarantees for Ukraine adds another layer of uncertainty. Washington is now openly discussing formal guarantees, and recent comments from President Trump signal willingness to contribute, but the lack of detail on scope and duration leaves markets guessing about the long-term structure of Western support. That ambiguity matters for European risk premia because it influences how much of the deterrence burden falls on Europe and how aggressively the region pursues rearmament and fiscal expansion. Looking further out, some strategists expect geopolitical risk to be less disruptive in 2026 than in 2025 as major election cycles pass and Middle East tensions potentially ease. But for now, investors are still dealing with a crowded geopolitical calendar and a higher baseline of volatility. The U.S.-China relationship remains a central fault line, with trade, technology, and security increasingly intertwined. On the tech side, Washington's export controls on advanced AI chips are designed to preserve a U.S. lead. And while these rules cannot fully block Chinese access, workarounds such as server disassembly and gray market flows underscore China's continued dependence on foreign technology. At the same time, Beijing is accelerating efforts toward semiconductor self-sufficiency and has proposed about $70 billion of support for its chip industry, while also tightening export licenses on products like steel. Recent U.S. interception of a Chinese vessel en route to Iran, seizing cargo allegedly tied to weapons programs, highlights how maritime enforcement can complicate attempts to stabilize trade relations. Political headwinds are also rising for Chinese brands in foreign markets, with some facing market exclusions and higher regulatory scrutiny, and Europe's heavy reliance on Chinese imports in pharmaceuticals and rare earths limits its room to respond. Energy markets sit at the intersection of many of these tensions. U.S. sanctions on Venezuelan oil companies and seizure of a tanker aim to cut off revenues that make up roughly 80% of Venezuela's export income, raising the risk of supply disruptions, even as the possibility of future regime change could eventually lead to sanction relief. Oil prices have lagged the broader commodity rally so far, but any renewed spike driven by tighter sanctions or regional instability would feed back into inflation and could challenge the more dovish central bank narrative. Beyond oil, rising state intervention in sectors deemed strategic, such as AI, rare earths, and critical infrastructure, points to a more politicized investment landscape. Episodes like Bulgaria's political instability ahead of euro adoption, rising populism amplified by social media, and pressure on multilateral institutions all suggest that governance risk is creeping higher even in developed markets. For investors, the watch list includes final EU decisions on Russian assets, the trajectory of U.S. sanctions in Venezuela, any further escalation in U.S.-China maritime incidents, and signs that political shocks are starting to move core rate and credit markets, not just local assets. Across AI, growth, and geopolitics, markets are increasingly discriminating between stories that deliver and those that do not. AI remains a powerful driver of earnings expectations, but the focus is shifting to margins, balance sheets, and real-world adoption, while the macro backdrop looks resilient yet tightly linked to policy choices and credit conditions. Geopolitical risk is operating through financial and energy channels rather than broad shocks for now, but key decisions on Ukraine funding, sanctions, and great power competition could still alter the volatility regime. Staying alert to dispersion across sectors, regions, and capital structures may matter more than simply tracking the index level. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.